In this video, we're going to start off our brief discussion of Chapter 12 by talking about quality costs. So quality costs in general, those are the costs that a company incurs to prevent defects or that result from defects in products that are known. So it's either the cost we incur to prevent defects from happening, or it's the cost we incur because defects already happened to fix that issue. So quality costs are made up of both of those elements. So the costs we incur to prevent defects, that is what we refer to as prevention costs and appraisal costs. So these are the costs we incur to prevent defects from happening in the first place. The costs we incur because defects already happen and we have to fix those issues and there's some problem with the product, those costs are called internal failure and external failure costs. So one way of looking at this is just the cost of conformance to quality standards. So prevention costs, those are going to be the costs we incur to reduce the number of defects that are happening. So that's the first cost we incur to actually prevent other costs from having to be incurred down the line. So that will include things like quality training, quality circles, and statistical control activities where a company at least spends money on these items to make sure that the number of defects is minimized whenever possible. Now, appraisal costs, these are the costs we incur to identify defective products before they're shipped out the door to our customers. So it's any cost we incur to check our products before they head out the door. So appraisal costs would include things like testing and inspecting the product and any incoming materials, final product testing, and depreciation of the testing equipment. So both of those are the costs that we incur, prevention and appraisal, before that product even gets out the door. So we want to prevent and then check our products, prevention and appraisal. Internal failure costs, these are the costs we incur as a result of identifying defects before that product heads out the door and is shipped to the customer. So this is where we find a mistake and we go ahead and fix it. So the costs involved with that. So internal failure costs would include things like reworking the product, spoilage, scrap, all of those things that are a result of finding an issue and having to fix that issue before the product is sent on to the customer. External failure costs, these are the ones we want to avoid more so than internal failure costs, because external failure costs are the costs we incur as a result of defective products actually being delivered to customers and then customers telling us, hey, there's something wrong with the product, it's not working, or something's not up to standard. So external failure costs would include things like the cost of field servicing, having to go out and service the product, fix an issue where the customer is, handling repairs, any warranty repairs, and also lost sales because of defective products being shipped to the customer. So external failure costs and internal failure costs, we want to avoid them, but internal failure costs are better than external failure costs because those, at least with internal failure costs, you catch the mistake before it gets shipped away, right? So both of these are normal parts of doing business, but you want to minimize whenever possible both of these as well as the external failure costs. That's where the prevention and appraisal costs come into play. If we're able to spend more on prevention and appraisal, naturally, we should have to spend less on internal failure and external failure costs if your prevention and appraisal is really high standard. Now, a quality cost report, that's just an overall document that provides an estimate of the financial consequences of the company's current defect rate. So it's basically a document that keeps track of all of your prevention costs, appraisal costs, internal failure costs, and external failure costs. And you can also see from one year to the next, you can put years next to one another and see how what you're spending on each of these categories, how that is changing. And you might see as an example, okay, going into next year, we can see that if we compare year one and year two, in year two, we ended up spending a lot more on prevention and appraisal costs than we did last year. But then in year two, our internal failure and external failure costs are a lot less than year one. So those are the kinds of insights that you can gain from using and setting up a quality cost report. It's just basically a detailed list of all of these costs and basically the financial consequences of having a specific defect rate. So the use of this quality cost information, ultimately, it's going to help managers see the financial significance of defects. A defect isn't something that, oh, it's okay that it happens all the time. It actually has a financial impact. It also helps managers to identify the relative importance of quality problems. So if they see that they're having to really rework a lot of products, a lot of repairs and warranty costs, that helps managers to actually identify where the problem might lie so that they can go fix that so the defect rate isn't as high. It also helps managers see whether their quality costs are poorly distributed. So for example, let's see if you set up a quality cost report, a manager can see, wow, we're spending very little on prevention and appraisal, but look how much we're actually having to spend on internal and external failure costs. Well, that would kind of make sense, right? The less you spend on prevention and appraisal, the more you're naturally going to have to spend on internal and external failure costs. So when something like that is identified and a manager sees, wow, this is a really bad distribution, a poor distribution of these quality costs, managers can then go in and see what can we do to spend more on prevention and appraisal so that in turn we get to spend a little bit less on internal and external failure costs. Now, quality cost information isn't perfect, right? There are some limitations. So one being simply measuring and reporting quality cost problems isn't going to solve the problems themselves, right? Simply being able to measure and report an issue doesn't solve the issue. So you actually have to use the information, not just set it up and calculate the information, but actually put it to use as a manager and find solutions. Second, results usually lag behind quality improvement programs. So you might make an improvement in this period, but you might not see the financial impact of those changes a couple periods down the line. So it can be misleading. A manager needs to keep in mind that usually results lag behind initiative to make helpful changes. So in year one, if we make some changes to spend more on prevention and appraisal, we might not necessarily immediately see in the next period a big drop in internal and external failure costs. It might take a couple of periods for that to balance out and for those changes made to actually have an impact on these overall cost amounts. And one thing that some companies often omit from the quality cost report is lost sales. So it's important not to forget that lost sales is actually a quality cost at the end of the day. It's actually considered to be an external failure cost, because if you have a lot of defects, you have a lot of warranty issues, some customers might want to return that product, then you're losing sales. So that is oftentimes external failure cost that is ignored or omitted from the quality cost report. So we want to make sure to make this information as useful as possible, not to ignore that important item. So that's our overview of quality costs. Now in the next video, we'll talk about throughput time, delivery cycle time, and manufacturing cycle efficiency.